Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, welcome to this very extra special episode of the Australian Finance Podcast.
Thank you. I'm very excited to be here. Why is it so extra special?
Well, on this day 40 years ago, you were born. Happy birthday.
Thank you. This is true. 12th of September, 1985 was a great day.
Happy birthday.
Thank you.
What are you going to get up to for your big 4-0?
Not much. So just like I've got the kids, so just like dinner with the kids, and there's like a pub. There's a pub around the corner from us that has like a big field. It's got chickens, rock climbing, like the jumping pillows and everything. It's just really, really good for kids. It's called the Doonan. It's awesome. So if you're in Sunny Coast, you should go there. So I'm thinking probably just go hang out there on the weekend, like just tell a few friends and stuff. So it's just really good for kids. But I didn't do like a big 40th. So I didn't do like a 21st, didn't do a 30th, not doing a 40th.
Aren't we going to do like a joint 40th though for you, Mitch and Pete in the team?
Yes,
Isn't there
absolutely.
Like a
so that's going to be my
Rask
40th. And that's going to be probably open bar on Rask.
Yeah.
Just put the credit card down.
Yeah. And that's, it's in a different state. You'll be in Melbourne when you do that. So, no rules, I guess. So that's exciting though. So we're going to answer some questions today. We've got questions about all types of stuff like home deposit, about use a recontribution strategy for people that are focused on retirement, so many different things. And we're going to have a bit of a debate about whether or not you do actually need property as part of your life/financial plan. So we'll debate that in just a second. But first, I wanted to ask you a question. What money lessons have you learned over these past decades? And what would you tell people that listen to the show or watch the show? Like, for example, what would you tell someone, a young child, if you could, what would you teach them from 0 to 10? Then what did you learn in your teens? What did you learn in your 20s? And what did you learn in your 30s? Take it whatever order you want, but yeah, what did you learn?
All right. So for under 10s, because now I know so much about money mindset and how early this develops, I say it all the time to anyone that will listen, right, regardless of the age, but just knowing that like money is a tool and that it can help or hinder you, and you have control over it and it can work for you, and just, like age appropriate, but just getting the idea that money's a tool to be enjoyed and to fund the things that are important to you, just instead of just kind of going through the motions. So that's what I try to tell people at kind of all ages. And it took me a really long time to realize that, like I'm going to say 30s. So that's what I am really focused on with my kids. So
cool. I like it.
Under 10, money's a tool. Teens, me personally, I learned that I can do hard things. Like I moved out of home, I moved to London. But I think what that comes down to is I think in my teens, and it was probably around 13, 14, when I started earning, got my first job and stuff, working for Dad's work, I learned the power of a plan. And I think this is where I became kind of like a planner. Anything that I wanted to do, if I had a plan, I made it happen, like London stuff. So the power of a plan for my brain, I realized like how my brain works. And now I just plan anything and can make it happen if I wanted enough. But that was like in my early teens, I discovered.
Can I ask you a question about that?
Yeah.
For people that haven't heard this before, Gem moved out of home at 16 and moved to London at 18. So when did you make that decision? Because that's just like people hear that like, oh, cool. Well, you're in London at 18, you're moving out of home at 16. Like that's pretty early days in life. Like when did you make that decision? When did you set that plan?
So the London plan, I had been planning for years, and I don't know how it got in my head. Like I come from like a country, like a smaller country town. and people didn't really leave unless they went to Adelaide for uni and things. So I don't know how I got that in my head. But then I was just like, yeah, I want to go to London, and I would have budgets, and I'd go to when you used to walk into a travel agent and I'd ask them for all the brochures, and I'd be like studying stuff. And I don't even remember we really had a computer or something then. I was doing it all manually. But yeah, I fixate on things, as you've probably realized. And I just fixated on, this is what I'm doing, and I'm going to do everything to make it happen. At the time, to get a visa, you had to have like 3 proof savings, and I think it was like $3,000. So I was saving for that. And then I remember you had to have it in your bank account for a certain amount of time. So I did a deal with Dad that if he would let me have like his money so it would sit there, I had a plan on how I would actually have the savings by the 3 months to give back to him, but I could show the genuine, like I'd mapped out time frames and everything. But yeah, I don't know. It's so I fixate on things, and I get an idea and I'm doing it.
So that's when you figured out you can do hard things and that you can plan. What was your 20s? What's your lesson from your 20s?
So 20s is when I found my passion for work. That was like all career. 20s to 30s was like all career focused. I learnt, like I started working in banks, and I just loved it. And I found like what I was good at as well. Like, yeah, and my passion for it. But also, I think it's why I was so passionate about it is because I learned that I can help people. I love it, but this is also going to help me. I get to transfer all these skills. So like I built my wealth in my 20s and then lost it in my 30s, but that's a different story. But like I was so passionate about it. I loved helping people, and I realized the power of transferring those skills into my own, success.
I like that. Yeah. So, okay, so 20s were like up. And then 30s, what was the lesson?
Crash. No, so 30s, this is a hard one because I'm going to say that this was late 30s. I'm going to say that this was probably from 37 onwards that I kind of I went through my divorce, all that kind of stuff, but I just really learned like boundaries, and that it wasn't all about money and success. And I think I just learned how to prioritize me and to lose the guilt around that. Yeah. But it's only been the last couple of years, so it's early days. I wish it was like my early 30s, but yeah, I think I just learned like where I spend my energy, how I prioritize me, and the knock-on effect on how that actually helps other people, whereas I always just prioritized others. And I think I just learned to be a bit kinder to myself and just chill out with your money goals, chill out with your career goals, just like enjoy life a little bit more. Like, yeah. Balance. So I'm going to say balance. Balance with money, balance with life, balance with career. That all came in my late 30s.
So I don't know if you're willing to share this, but you've always had a pretty ambitious goal for your finances and whatever. When did that take on?
Early. So I think because I had goals like even through my teens. Like I remember when nobody really had like TVs in their room, but I had a first job and I was like, I'm going to save for a TV in my room. And so I've always had like goals that then I put a lot of pressure on myself to like save for them. So it started really small and then it spiraled into big ones like, well, this wealth target and like all that kind of stuff. And it kind of spiraled as well when I became a financial advisor. Like I can pinpoint where the unhealthy money habits really spiraled because I was seeing people in terrible situations that I was like, I can't, like I've got so much responsibility to my family to make sure that we're not in that position. And then I'd see people in amazing positions and I'd put pressure on myself to be in that. Whereas, I was like, if I do this all day, every day and I help people, like I just put so much pressure on myself. But now I'm kind of like letting go of that a bit, a lot actually, I'd say.
Yeah. Okay, cool.
This is my midlife crisis.
Yeah.
And I'm all for it.
We'll come back to probably where that comes from in just a minute. How's your week been?
It has been great. It's been really, really productive. Got heaps of cool episodes coming out. Got to interview some really cool people. So I've had a great week. I'm hoping this is just smooth sailings into my 40s. What have you been up to this week? You told us last week you were pretty stressed. How are you feeling?
Less stressed. Yeah, it's been a lot. Like people would know this, but like we have our own financial advice business now. We've also got our investment platform, which is doing really, really well. Like I just did the numbers last week, and it's like really good to see that we've outperformed like all the Vanguard, not all of them, but I think nearly all of the Vanguard funds and the diversified ETFs and that sort of stuff, which has been really cool. After fees, by the way. And so like that's been going really well. It's still small, but it's busy. Like you can imagine managing tens of millions of dollars for people. That's a lot. So then the podcasts are going really well, and we're in like a bull market. Everyone thinks that, 10 to 20% returns per year are normal, which is scary for us as we create content. And then we're moving offices. Like it's just been a lot. We've got new team members. It's all really positive, but it's just been a lot. So I'm happy because I'm going to go up. I'm going to fly over your house and I'm going to Port Douglas next week. So stopping in at Palm Cove, which is where we got married, at the new restaurant there for people. There's also a chapel on the beach. Absolutely delightful part of the world, I would say, which is Palm Cove and Port Douglas. So heading up there. And then we're going to be working from Sydney for about 7 or 8 days as well. So there's a lot to look forward to, a bit of a circuit breaker, which I definitely need. And better this week, Gem. So thanks for asking. But we do have a lot of questions and a topic that we want to debate. I do, however, seem to think that you've put some extra special notes in here down the bottom of our doc that we're working on today, Jen. We don't script any of our episodes. No episode at Rask has ever been scripted, I don't believe. So you should know that we do it all on the fly. But you do have some notes down here in a document that I can see. And it says September 1985 fun facts. What are they?
Yeah. So when I was like, what are we going to talk about on today's episode? And I was pulling out the questions. I was like, I wonder what was going on 40 years ago. And so interesting. The weekly average earnings was $380 a week for a full-time adult, $20,000 a year. The average mortgage size was $37,500. Crazy.
Wow.
But that was 2 times an annual salary. Which has changed a lot. The average house price was about $82,000 for just a small standard dwelling. And inflation year on year, which is very topical for where we've been the last few years, was 6.5. So it was actually pretty high.
Yeah. Think about that. Everyone listening to this, think about 6.5% inflation. We only had it for like a year, not even, but that's what it was, pretty standard back then. 2 times your annual salary. So whatever your salary is, if you're listening to this, times by 2, that's your mortgage.
That'd be nice.
Yeah. Well, yeah. Yeah. Just think about that. Anyway, that's a whole debate for 10 other podcasts. But it really does put it in. I would love to know what interest rates were back then, because if inflation was 6.5%, I wonder what interest rates were in 1985. We could probably look that up, because I would imagine that interest rates were above 6.5%.
Was that when they were about 18? At some point,
they started to peak in the late 80s into the early 90s. So there was this is a time inflation was running at COVID levels every single year, and interest rates were sky high. And the way you got a better rate on your interest was to go down and meet with the bank manager and negotiate for a better rate.
Yeah, it was
try to lock it in.
You knew.
Yeah, otherwise you were paying 18% interest. Like,
okay, mortgages were around 12-13%.
Wow. So that's why they had to be 2 times the salary, right? Because there was a lot of interest getting paid. So that's a bit of a time warp, and really just puts it in perspective for people. And now the average wage is like 4 times that. There's a lot going on. Mortgages are way bigger than $37,000.
Yeah. Average house price being $82,000. I think you can get anything for under $1 million anywhere on the Sunshine Coast.
Yeah. So crazy times. But fun. It's good to see. So thanks for digging those up. So general advice warning before we get into the questions is strictly general in nature. We don't know your needs, goals, or objectives. So if you do answer your question today, just be mindful that you should speak to a financial planner, or at least consider your own needs, goals, and objectives before you act on the information. Funds and ETFs and things like that have a PDS and a TMD. They're the documents that help you understand what you should do and if a super fund or an ETF or an insurance thing is right for you. So make sure you read that. And of course, Rask has an FSG, Financial Services Guide, that's available on our website. Now, the first one is very topical, not so much because it's your 40th, but because you have recently been talking about this. We talked about this as a team yesterday, the advice team. Do you need to own a home in Australia? Now, what's your perspective on this? Someone sitting at home, do they need to own a home?
Yeah. So this is a home to live in. And I'm talking to more and more clients that don't feel like they need a home in their like 40s, 50s, like the priorities are shifting. But the consensus all seems to be that we think we need a home in retirement. And that's where I'm kind of going, I wonder where you sit on this. So I honestly, I'm big on rent vesting and all that kind of thing. I don't live in the house that I don't own the house that I live in right now. But when I think about it, like I do think in Australia, the system's set up, you really want to own your own home in retirement. But I see it shifting that we don't prioritize that in our like working lives. And I think that's where I sit. I'm like, I don't think you need to own your own home to build wealth, but I wouldn't want to be renting in retirement for the kind of lifestyle that I have. I want to own my home in retirement. And I'm seeing a bit of a shift for, even the people that aren't traditional homeowners now still have that feeling. Like that's what I'm kind of thinking. What do you think?
Yeah, it's a good perspective. I share a lot of it. I would say that it's really interesting. If you speak to a lot of people under 40, I'd say it's pretty mixed nowadays. The advice team, as you know, we sat down yesterday and I just went around the room and I said, in the next 10 years, does anyone think here that you will have an investment property? And I was thinking, we're all finance people, we all, blah, blah, blah. I thought like the majority of people would say yes, but I don't think anyone did.
It's shifting heaps.
I was like, what? I'm like, am I the only one here? I'm a shares and ETFs guy. Don't get me wrong. Like I love businesses and all that sort of stuff. But I'll probably own an investment property. I'm going to guess that I'll probably own one. I know you don't need to, but I was thinking property is a good vehicle. And here in Australia, it's expensive, but it's hard to see it going away. And then if you think about like at the people that can't afford maybe even like a home to live in at retirement, the reality is that it actually does favor you to have a home, even if it's like a unit or an apartment in retirement for things like pension rules and that sort of stuff. So, and Centrelink, there are benefits.
The system is built for homeowners. It literally is.
Yeah. That you can get a little bit of a rent assistance and that sort of stuff if you do need it or if you're a parent and that sort of thing. But it does actually pay to, even if it's a small house, even if it's not, it's just really modest, it does make sense. And I think what you're getting at maybe is that it's maybe a concern that you have that maybe people in their 40s aren't prioritizing it because they think, well, I don't ever need one. This is my life for life. Is that what you're worried about? Like that by the time they do get to 60, they're like, oh, I should have done
I'm
that.
just seeing a real shift in when that's a priority. Although like yesterday I met with two clients, amazing clients, both 22 and about to buy their first house. And I was like, wow, that is crazy. I'm seeing like a real divide on if people feel like they need to own a home that they live in or not. And where I kind of sit is probably don't need to prioritize it, but you need to prioritize having enough wealth so that when that shifts and you do want that security and you know where you want to live, that you've got enough wealth to make that happen. And that's probably the boat that I'm in at the moment. It's not a huge priority, but building enough wealth so the minute that it does become a priority, because I know it probably will, I'm not that far out of ever getting back into that market.
Yeah. I think you just got to do something. You just got to do something. There's the three big things that matter to everyone listening to this: property, super, and like your shares and ETFs. Those three things, you got to do at least one of them. Ideally, you do a bit of everything. Like you got to do at least one, even if it's $50 a week, even if it's $10, using Raise or something like that. Like just, you got to do it. And if you don't have the means, the next best thing you can do is teach your kids and the people around you, because give them a chance to, with the knowledge that you give them, that those are the three things that really matter. Consistency into those things over a couple of decades will change your life. So I'm in the camp of, in an ideal world, people will be able to own the homes. And I think that there will be some good changes over the next 10 years. I'm always optimistic. I think that we know that it's an issue as a country, and there are good people in the world. I think most people on average are really good people, and I think there will be some change. I think the latest first home buyer 5% deposit guarantee scheme thing, whatever you want to call it, I think it's an absolute joke. I think it's a really horrible thing for Australia over the long term. But if you are in a position to buy a house now and you thought you needed a 20% deposit, well, you don't. The government is basically saying you definitely don't need a 20% deposit. You're going to have more of a mortgage, but you definitely don't need a deposit. So hurry up and get in contact with your mortgage broker to see what your borrowing power is and see if a property's in your financial future. Quickly on that, there was an email that I sent out over the weekend about this and why I think it's a really bad thing for the property market and for first home buyers overall, because it's already, I was chatting to some buyers agents yesterday, it's already adjusted the prices up in some places. Like
it puts more fuel on the fire. Yeah.
Yeah. And if you haven't heard this message yet, the government is effectively paying for your lender's mortgage insurance. So if you thought you needed a 20% deposit, now you only really need 5. You will have the extra 15% as a mortgage. So you'll have a 95% mortgage, which you got to repay obviously, but yeah, it's
just
scary.
Puts more people, it gives you more competition, which is going to drive up property prices.
Yeah.
But yeah, and like what else is the solution, right? Like we're so far away from any other solution. That's a quick win that they think that they can offer.
Good politics, bad for property, or good politics, bad economics. But on the optimistic side, seeing property prices behave the way they are, and the government is not silly, over the long term, we will see more builders come back into the market. We will see more investors come back in, and hopefully council rules and state government rules change and there'll be more housing. So hopefully the housing affordability debate is not the big one that we're having in 5 years. And there's a lot of supply coming on, like more apartments. If you look around Melbourne, like it's crazy how big Melbourne's got over the last 10 years. Brisbane's the same, less, probably more constrained in Brizzy. Sydney has a lot of work to do. Perth's coming along. So like you can start to see it all taking shape, and hopefully that's a good thing for everyone writ large. So yes, property from me. Yes, property from Gem. Just be mindful, I think, from both of us is what we're saying. Okay. Finance GPT nerd. Obviously, this person's been spending a bit of time in old Chad. I bought my first home last year and the deposit came from an inheritance. Now, more than half of the loan balance is covered by having cash in an offset. That's pretty cool. As interest rates are going down, is there anything else I could be doing with the cash, e.g. stock investing, property investing, etc.? Currently, my interest rate is 5.53%. Pretty decent interest rate, actually. What do you think, Gem? So they've got a bit of equity in their home is what they're saying.
Yeah, absolutely. There's so much you could be doing. You know, we talk about debt recycling a lot, property investing. You could absolutely be using that equity, but I was going to add on this. I love that you're thinking about that because that's building wealth. But in terms of what that money could be doing, say, if it was investing, there is still a lot of risk with that. So 5.5 is still a high interest rate. By having it offset, you are saving interest, whereas when you have it invested, you are earning interest and then paying tax. So you need to really gross up that return to even net off. Does that make sense? So you probably need to earn like over 8% to pay tax just to net off at that same return, like the value of it. But you know, that's not your only consideration. Like you want growth, you want other assets, but just from a return perspective, when you add on tax, risk, all those kind of things, like it's still a pretty high interest rate. So I don't think the money's doing nothing by offsetting, but building wealth in other areas, absolutely. But yeah, there is a balance there. It's not as easy as, oh, the interest rate's only 5.5. It's still pretty high. It's not like when it was 2% and it was like, well, this is a no-brainer, even with the risk. Like obviously the share market, you would go. But yeah, this one was still on the cusp of, it's still pretty high, I think.
Yeah, so it's interesting that you say that, Tim. I probably have a slightly different take on it. I tend to see that most people ask these questions, and you'd have seen this through financial planning days. Most people ask these questions whether the interest rates are going up or going down. So they're like on the way up, they're like, oh, interest rates on the way up, I'll have more money in my offset account. And I say, yeah, but it doesn't change your repayments. And then on the way down, they're like, oh, interest rates are going down, I should invest. Yeah, but stocks have already gone up. So you kind of like, you have to I think this is actually a structural change that people need to have in a strategy rather than a short-term move, if that makes sense. Like, I think people approach this like interest rates up or down, make decision. I think this is actually like a 10-year strategy that you pursue because you think that over the long term, investing will slightly outperform the interest rate. And if it slightly outperforms over 10 or 20 years, then that's amazing investment strategy, right? As we know with compound interest. So what I would be inclined to say is the strategy that I'd see most commonly from people that want to grow wealth in this situation is not to leave money in an offset account. Although it feels good, it's not the most effective. So what people would be inclined to do, and this is general in nature, we don't know who this person is pay off the mortgage, like actually physically pay it off, assuming you know what you're doing, pay it off, then redraw. Because you can't just take money out of an offset and then invest it for what I'm about to explain. It doesn't work. It's called a mixed loan. So what you need to do is you need to pay it off, then refinance and redraw like say 100 grand or 200 grand. Then you take that 100 or 200 grand and you put it in a diversified ETF portfolio. And what you get is you get the amount of the loan that comes out as like a redraw. You could say to the ATO, that's an investment loan. And so therefore the 5.53% is now a tax deductible interest bearing loan. So the 5.53% is a tax deductible loan. Yes, you have a bigger mortgage overall, but that bit is tax deductible, right? Then you invest in, say, something like a broad-based, higher growth ETF portfolio. It will pay franking credits. So you will get some tax minimized on the gains and the returns that you get, while also getting the tax deduction on the other component. That's what we call equity release and debt recycling broadly. And for people with a 10-year time horizon, I see that makes the most sense. There are a lot of rules. I think this is where financial advice will pay for itself. Like, you're better off working with a financial advisor and setting it up correctly, because there's a lot of steps involved, and you want a good mortgage broker and they can help facilitate that. You want a good accountant and they can help facilitate that. But that's where I see a lot of accumulators, Gem, make a lot of money out of financial advice. That's what I'll say for today. I don't know if you've got any comment on that.
Yeah, no, absolutely. Like a debt recycling, how you structure it is very, very important. But yes, I'm just thinking that, we're getting a lot of comments at the moment about where do I get 10% returns and things. And I'm kind of going 5.5. You've got to be aware of your risk, because if you're thinking you'll save 5.53 to make 10%, it just really, I want people to be really realistic with their expectations on what an investment can do as well. But yes, debt recycling.
So you wanted me to comment on this as well. I'm doing a webinar. It's actually at the time of this podcast recording, it's actually today. It's on the Rask YouTube channel. And so on the Rask YouTube channel, I'm doing a monthly update for our investment service. And it's about 10% returns are good, right? And the whole point is that right now we're dealing with this across our entire business is everyone's coming to us and saying 10% returns are guaranteed, basically. I'm like, what are you talking about?
Expectations have changed, that it's like the norm.
If anything, it's the opposite of that as we sit here in 2025. Like, the returns are coming down, not going up. It's just that these big tech stocks in the United States have kept going up, and gold has kept going up, and Bitcoin's kept going up. This doesn't always happen. Like, that's very, very rare in human history. So you can't just go 10% versus 5%. There's tax in the middle. There's all this other, there's costs associated. Like, really just think carefully. But just generally with the question, should you do something with the equity in your home? If you're a growth-focused person, absolutely. Yeah, it's a huge, huge thing. So, yeah, good one. Question for you, Gem. This is from Reconfused?
Fused?
Yeah, it's
Reconfused.
Reconfused. We'll go with that. This is a good one for you. What is a recon strategy and why would you do it? So this is more of a super thing?
This is superannuation, yes. So this is a recontribution strategy, or you might hear it called a cash out and recontribution strategy. So what it is a superannuation fund. So you've got one super fund, it's like a big bucket, but there is a clear line down the middle of it, and it has two components, a taxable and a tax-free component. Any money that came from work that was a salary sacrifice that went in concessionally goes into the taxable side of the bucket, and anything that you've added yourself, non-concessional, that's been taxed elsewhere, you've been taxed through your pay, through bank account, and you've added it in, that goes into your tax-free component. Now, once you're retired and you're drawing from your super, this really has no impact on you under the current super rules because it's all tax-free to you if you take it as earnings. But where that definition and why they still keep a record of it is because when it goes to your beneficiaries. So adult children, for example, non-dependents, they will pay tax on whatever is in your taxable component, and whatever's in the tax-free side of the bucket, they'll get tax-free. So this is why there's always a record. It doesn't impact you so much, but it impacts your estate. So why people might do a recontribution strategy, so to take money out of their super when it's all tax-free to them, is so they can put it back into super and it goes into that tax-free side of the bucket. So that's one of the major reasons why we would see people do that. So from when they can access their super in retirement, they might, if the rule is you can add back 360,000, they might take 360 out and add it back. It's just moving it so it's in that other side of the bucket. So that's the main reason people do it, for estate planning, if that's a chance that it's going to go to non-dependents. The other reason why you might do it is between spouses. So taking a big chunk out of one spouse and going into the other person's. That could be to even up balances. It might be to access some Centrelink if one person's a lot younger. So there's lots of different strategies, but the main reason is because there's always a record of what's taxable and what's tax-free, and they want to move it out of the taxable, which they're not paying tax anyway, and they want to up what's going to be in that tax-free component. That's a lot of words of tax. We could probably...
we could do a whole episode of that, and we'd need 10 different flow charts. But
yes, but essentially you're just trying to move it from one area of the bucket to the other, and it can have lots and lots of value. But this is why, this was probably my favorite strategy as a financial advisor.
Yeah, it makes sense because it's not just about you, it's about everyone. And you can lean on your financial advisor for this. And it's a good one to start I think we've always said this on the show since we started in 2018 is at retirement, get financial advice. Like more than any other time in your life, it is the most important. I was chatting to a couple this morning, lovely couple. I was like, I reckon that financial advice is going to pay for itself at least 10 times over because the strategies that you guys have that you wouldn't want to do if you were just by yourself, it's really important. This is one of those ones that can help. So yeah.
This is a really cool one. Like if there's an age gap and somebody's going to get to 67, you might not be eligible for Centrelink when you're both 67, but there might be a period where you can get the maximum Centrelink age pension while the other person's younger. And like strategies like that can really, really boost your retirement. There's so many cool things, but that is my favorite financial planning strategy. So
yeah, cool. Like it. Okay, we've got two more questions. One's an ETF one is an investment property one. Unique's mum says, "Hi, hey guys, love the show, great content. I'm more of a share investor, but I'm keen to help my family by buying an investment property. Where is the best place to go for help? Thanks." That's a good, just clean question. Where do you go if you're trying to think about, is an investment property right? It's a good question, Gem.
Yes. So, easy. You would talk to a mortgage broker about borrowing capacity. You'd maybe talk to a property advisor. You'd start, researching properties. But the thing that I kind of felt was all really straightforward. Absolutely start with a mortgage broker. But the thing that concerned me in this question is I'm keen to help family buying an investment property. And anytime I hear help family, I have a little bit of a panic. So depending on, that might mean I want to buy one myself so that it sets my kids up later. I don't have enough info, but my thought was, I wonder if they're buying it with another family member, and then I go, oh, family messy. So if that is the case, I'd be going, right, let's clearly define the relationship, how we're buying it. If it doesn't work out, the exit strategy, all that kind of thing, have really good legal structures. But yeah, if it's as simple as like, how do I actually just go to buy an investment property? Then I'd always start with a mortgage broker. What's your capacity? Working out your cash flow in, if you can borrow this, can you actually afford it? How much are you going to be out of pocket with when rent comes in, but you've got rates, repayments, that kind of thing. And then maybe a property advisor if you want help buying the actual property. But I did have a little panic that help family might
it's
be
where
messy.
things go wrong. Yeah. Yeah, you need to get advice because like we were just talking before the show hit record, you can have what's called tenants in common or joint tenancy. And we, even as financial people, we get this confused in our brains, but tenants in common, which is what we believe it to be the case. So I'm just going to bring this up again on my Google here. Tenants in common is effectively where you can have a property divided into quote unquote units. So I could hold 70% of the units and Gemma could hold 30%, but we buy the house together. And so under law, I've got 70, Gemma's got 30 if we were to sell it. And that's a really good one. So yeah, here's this is from the Land Vic. I think this is because we're in Victoria, or I am. Tenants in common is when two or more people own shares in a property. And so this is a really good one. Whereas joint tenancy is when you say like a husband, wife, boyfriend, girlfriend, whatever the case may be, you buy a house and you don't even think about it, you just buy it. Well, the law says that that's pretty much shared between you, and it can get a bit messy. So,
and that means if one of you pass away, the other person now just owns the whole house, whereas the other one, like if the 70 and 30, if I passed away, that my 30% goes to my estate.
Yeah. Legal Vision also backed up the Victorian government, luckily, because we don't trust the Victorian government. It says, when two parties own property as tenants in common, it means that two or more people co-own a property in defined shares. It's really important to understand if you're going to go down the property route with family and friends. On average, I'd say it's worked out for the worse. In my experience dealing with people, it's more often the case not worked out. I would say if you're going to do this with family, even if they're loved ones, is know who owns the property, have things written down, and if you need to use some structures like what we call co-borrowing, where there's like a few of you borrow together, or if there's a guarantor, have very clear expectations. The bank would want you to sign things anyway, but have very clear expectations, document everything. And
make sure you can communicate really well about what happens if this doesn't work. How do we get out of this? How do we keep the relationship and make this a business decision? Because
what would happen if? What would happen if? What would happen if? And then sign it, right?
Yeah, and if those conversations aren't flowing before you've even made the decision, they're not going to be something that you can talk about when stuff's going pear-shaped. So
the other thing here is, I think mortgage broker is a good point of call. If you've got a financial advisor already, just speak to them first. The reason I would say that is because you don't ask a barber if you need a haircut. So, because I'll just say yes, of course, unless they're talking to me, in which case I'll probably be like, doesn't really matter. But I'm being legit here because the reality is that if you go to like one of those property first people, you're going to get a property first answer. At least a mortgage broker is under a license, has to like speak to it from the business perspective. Only a financial advisor can actually say, well, here's what it would do to your cash flow. You told us your goals were this, but now you're doing that. Or here's what the tax implication of that would be. Whereas, the actual mortgage broker will just mainly speak from a lending perspective and a property perspective. So start with probably a broker, get a feel for it. And if you want to get a professional opinion on individual properties, that's where a buyer's agent comes in. So some really good ones around there. Also, we've talked a lot about property today. If you want to use
we really have.
mortgage broking, our good friends at Alcove, which is Chris Bates, who's been on the show before, you probably know, and a lot of people have used him. Hundreds of people have gone through Alcove at Rask now. You can support Rask, but also get a great mortgage broker on your side by going to the link that will be available in your show notes. Final question comes from Still a Novice. What is the difference between having Betashares or Vanguard directly holding my ETFs versus having a share registry like Computershare do it? I notice I can create an account with Betashares and it's prompting me to move my Betashares ETFs across. I'm not 100% sure what that second part is.
I was a bit confused with this. Do they mean that the Betashares ETFs are held on the Computershare registry and they're saying get them off the registry? I wasn't quite sure. So I was like, Owen will answer this one.
No, it's a good one. I should have done a check of this before the show, but So basically the way it works for most people is that when you own shares using a HIN-based broker, every single thing is legally held in your name. I'm not 100% sure of the underlying legal structure of the new Betashares platform or even of the Vanguard platform. I know that they're custodial models, meaning that instead of having your own individual number and your own legal ownership of the ETFs, what is actually happening is the companies in between that, which is Betashares or Vanguard, and you have a right to the custodial model that then is held like by the exchange that recognize that. So instead of having, we've talked about this a lot so a good example is, and these are both sponsors of the show. So we've got Betashares and Perla. Perla has a HIN-based platform. Betashares has a custodial platform. That you pay a little bit more for a HIN-based platform when you trade a little bit more, but the difference is that you have full legal, like kind of identification to that individual investment. When you have a custodial model, which is the common model around the world, the fees that you pay are typically a little bit lower, but you have a right to the shares, but they're held by someone else as a custodian. And so that's kind of how it works. And there are good and bad to each thing, and there are pros and cons. When you think about things like voting on individual things, oftentimes HIN-based and these types of things do have a bit more going on, like you have a bit more rights and those types of things. There are pros and cons. Our platform at Rask, our Rask Invest platform, is fully HIN-based because we believe that people wanted that. And the key thing, and this is how it ties into the share registry, is that, say, for example, someone was with Perla or the Rask Invest platform. If you wanted to go and move to CommSec, for example, you could just take your HIN number and go to CommSec and say, hey, CommSec, this is my HIN number, bring the shares across. And then it'd be, boom, appear in your CommSec account, right? It takes a little bit more time than that, but you get the idea. And why this is probably more relevant to a lot of people is that people have a bit more, I don't know if they feel like there's more or less faith in the ASX right now, but they feel like it's a good thing to have. So they choose to pay a little bit more. The final thing is on the registry side of things. Computershare, Boardroom, Link. These are the companies that actually do kind of the tables of like, who are all the shareholders of BHP? Who are all the shareholders in the VAS ETF? Who are all the shareholders in Apple? They're called share registries, and they sit between you and the platform you use. And it's like an administration platform. And so if you use one of those platforms or you own ETFs in VAS or NDQ or any of the ETFs, you should be able to go to the share registry and control things like your dividend reinvestment plans and that sort of stuff. Now, I don't know the specifics of why, in this instance, Betashares would have said to move it across. I'm imagining they're talking about what we call an in-specie transfer. So this is where you can transfer your existing shareholdings to a platform and not incur brokerage fees.
Yeah,
so
or without selling them down and triggering capital gains tax.
Yeah, good one. So you could say, I've got $100,000 of ETFs and I want to go and use this new platform, but I don't want to sell them and then have to pay the tax and brokerage. Well, I'm just going to do a transfer of the actual investments across there. That's called in specie transfer. I think it's a Latin word, which basically means that like you take it in kind and you push it across. So, but the idea with that is that you could then transfer holdings. You just want to make sure you're clear on what it is you're getting at both platforms, because if you stuff it up, it will be rejected, number one. And number two is you don't want to accidentally cause yourself any tax, because it's just annoying. And when you leave a custodial platform, sometimes there are fees involved. I think there are fees involved in HIN-based platforms as well. So just check to know what the fees are on both sides of the table. It's a good question. Lots of interest in all of those ETFs, and it's a good one. We've got a full guide on share registries. So just to recap today's episode, Gem is turning 40. She recently did a money reset, and no, I'm not talking about buying a new house. I'm saying she wrote a book called The Money Reset. It is out now. Amazon, Dimex, your local library. Someone wrote into us and said that they had 3 books in their local library, which is really cool. So Gem's just making bank on that.
Hardly. That's an episode that's coming out actually probably next week or the next couple of weeks. It is a book a good business strategy and how much does it cost? So watch out for that episode. Spoiler, no.
But it's fun, right?
It's fun. It's totally fun.
We talked about, pros and cons of owning property. If you can do it, it's great. We think for multiple reasons. Finance GPT nerd asks about using it like the equity in a home. Definitely a good thing to speak to someone about or do some research on. Confused Recontribution strategy. It's a lot there. Unique's mum asks about, I said, loving the show and a share investor looking to buy property. Just be mindful of buying property with family and friends and that sort of stuff. And finally, the difference between Vanguard and Betashares. They are custodial models versus a HIN-based model, which are other types of options too. If you've got a question for next week, we would love to have it. You can send it in via the link in your podcast player. It says ask a question. It's really easy. We love to get questions this way because it helps us kind of stay on track. And you just select the Australian Finance Podcast. I think next week, the Honourable, the great Tali Cavagnino may be joining Gemma. So I'll be...
Yes, you'll be on holidays. So the next 3 Q&A... Yeah. Well, maybe Tali and I will have some mojitos on the show in solidarity. So the next 3 Q&As, I'm going to pick somebody different from the team. So we'll probably have James, one of our financial advisors, Tali next week, and then we might get Mitchell back, our investing head of funds.
Head of funds, yeah. He's also head of junkets.
Fun too.
Head of fun, FUN. So there's going to be some great unique voices on the show around. But get your questions in because we love to hear from you. Remember, we would love to see you at any of the upcoming events. We're going to Her Wealth, Her Way in Sydney in a couple of weeks. So if there are tickets available or if you're coming, come up to us and say good day. We've got a couple of hundred of Gems books to give away. We've got some Rask merch. We've got some goodie bags. So come along to Her Wealth, Her Way in Sydney in a couple of weeks. Gemma, absolutely happy birthday to you. It's been a great day.
You.
I hope you have a great weekend at the rock climbing wall. I can just see it already. Vino in hand.
I won't be doing rock climbing. It's a kids' wall. I'll come to work with like a broken arm. Like, this is 40.
No, but seriously, happy birthday. Congrats on the release of your new book. The Money Reset is out now. Absolutely splendid to have you. And happy
Enjoy
birthday.
Your holiday.
Thank you.
See you back in a few weeks.
See you next time. Thanks for listening. Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.